Fantastic. So we'll get going. I just wanted to really just lay out a few bits because obviously we've just had the open, the futures, the open in Europe. Markets have just opened in Europe. The futures were pointing to a small decline lower. That comes after 2 days of gains for European stock markets, and that's exactly how it's panned out. Though markets are down between 0.5 and 0.9%, something along those lines. We've had we've had a lot of news out, so I'll just give you a little bit of background. To start with, obviously, we've had Europe has still been kind of front and center. The latest news on that is that the EFSF fund, so the Eurozone finance ministers have been meeting. They continue to meet today, but it looks like they've made some groundwork on really how to boost their rescue fund. But I think now there really is a sign of too little too late, and I think that's why we haven't had this kind of big market reaction. Markets are still a bit range bound, a little bit cautious about what's going on. I'm going to show you a lot of charts so that we can really see that caution and how it's playing out in the market. But basically, I think investors, certainly markets, there's a greater realization now that actually more needs to be done. So it's not just about the EFSF rescue fund. That's only one side of the problem. We've got to get the IMF involved to really boost this thing up. And we've been told that they will work with the IMF will work with Europe, but we don't know to what extent and how they'll expand their role. Added to that, I think a lot of people are really looking at looking towards the ECB to try and boost or try and provide a long-term financial backstop. Added to that, also overnight, you've had the S&P bank downgrade. So they downgraded an awful lot of banks, so some of the world's biggest banks. Obviously, it's just kind of almost kicking them when they're down, really, because everybody knows how much trouble they're in. But it's just, typical ratings playing catch-up, really. But that has obviously dogged sentiment as well. So everyone from kind of Goldman to UBS, they were downgraded last night. And there was really this kind of rout in global banking ratings. So those of you who were trading the markets last night, there was some fun and games, that's for sure. Let's take a look at a couple of charts. Obviously, I just want to start with, just bear with me one moment. I'm going to pull up my chart. Right, so this is the 30-minute chart in euro dollar. So as you can see, it had a very sharp move yesterday. Let's even get it on a shorter time zone. So this is from today. So obviously saw that kind of bounce back at we kind of got as high as 133. Sorry, here we go. So this is yesterday's price action. So that bounced all the way up above 134. It then fell very dramatically on the back of expectations, on the back of reports, actually, that the ECB hadn't managed to sterilize all its bond purchases. Now, what does that mean? Why is that important for any technical analysts out there? Well, that means that it's that's QE, essentially. That's quantitative easing, because it means that there's more euros than would be normally sloshing about in the system. So the ECB has been buying bonds, but it hasn't been able to sterilize all of those purchases. So it hasn't been able to sterilize all of that money that they put into the system, which usually they do by selling bonds. So there's been a mismatch of the tune to about 9 billion. Since the ECB has been so adamantly against QE, the Bundesbank is so against it. That was big news. So hence this move down here. So as you can see, certainly in the very short term, really been trading in fairly, tight 250 pip range there between kind of 134 on the upside and kind of 132.50 on the downside. Now, I'm going to draw your attention to here. As you can see, we saw kind of sharp losses overnight. That was on the back of, again, probably disappointment from the EFSF, from what the Eurozone finance ministers were saying. Added to that, a little bit of risk aversion that came through from those bank downgrades. So we had the large move. We had the large move during the Asia session. Are we finding a little bit of support here? Well, potentially. The euro has been absolutely vital for global risk appetite overall. And really, obviously, because problems are in Europe, we are finding that the euro is tending to lead things, or is certainly one of the leaders of asset classes on an intraday basis for where risk is going. I would draw your attention here to the MACD and the RSI, both of them starting to look oversold on a very short-term basis, so we could start to see a bit of a turn up here. So it looks like we've managed to hold resistance above 132.50, about 132.65. And potentially we'd then have to target kind of 1.3 on the upside, and then I'd look at this 50-day moving average at 133.12. But again, just looking at the bigger picture, what this means for the longer term traders out there, it's just a further weakening, really. As I said, the next target to look at is 133, then 133.20, maybe even 133.50. But that is still away from the peak of last week, or the peak of yesterday, even at 134.40, and the peak of last week when we got up to 135.50, and it wasn't that long ago that we were back at 136.50. So yet again, we're making this kind of, if I look on the daily chart, you can see it better actually, just these series of lower highs, which just suggests that people are grinding away at the euro, and it's losing support, but in a very kind of weak basis. It's been a very slow burner all the way down to 130, but as you can see, it's very weak within that range. If we were to get more bad news or to get another push by the bulls, it's probably going to be something regarding the banking sector, we think, and that could potentially see this shift through 130 very quickly. Otherwise, we think it will be a grind lower. Now, as I've said to you before, that 130 level is really respected by the market. 131.50 or just below 131.50 has really been the low, was the low in October. Before that, the low of the year was just below 130, so kind of 129.50. That came back in January. So what we were actually seeing, if we're going to try and interpret the price movements over the last 12 months, you would say that euro's really been range trading between kind of 150 on the upside, 130 on the downside, and right now at 132.75, where price is currently trading at, we're looking very weak within that range. Obviously, that we've got to get to that 131.50 mark first, which then opens the way to 130. Now, I'm not going to give any big long-term predictions. You're not going to find that from me here. But one thing I would say is that around here, we think we're going to be very, very sticky. We think it's going to be a very, very sticky, choppy move to that 130 zone. And as I said, it is a respected level. And when you get these respected levels in FX, you've got to respect them, of course. But I'd also add that a lot of this is fundamental driven. Yes, the European authorities seem to have done a little bit too little, too late. But if they were to pull out all the guns, if the ECB were to come back in, funnily enough, that could actually be when the euro is to weaken substantially. So at the moment, as I mentioned, I'll just make that a bit clearer. So on a fundamental basis, if the European authorities were to come in and everything is to be fine, then we could see a bit of a sharp pullback. However, we seem to be converging around the idea that the only way to solve this crisis, right? So the only way to really stop the contagion, to really get debt levels down, is for the ECB to come in and to act as lender of last resort. Now, what does that mean? That means that they have to buy up bonds. What does that mean? That means they have to flood the European economy with euros, something which they haven't done ever in their history, which is certainly something to watch. Certainly not unsterilized anymore, but we need huge unsterilized purchases of eurozone debt to try and get this crisis under control and try and stave off a recession. For the euro bloc, it's what the Bank of England does, it's what the Fed does, and there is certainly a convergence around the idea that that's the only way that the ECB can deal with this. And so weirdly as this may sound, we may not get a full kind of collapse or a real convincing move below 130 until we start to see the ECB step in, because obviously then you've got more demand, you've got more supply of euro than you have demand. So very easy economic analysis of why the euro would then fall. But what I think is difficult for some people to get their head around is that we might actually need things in Europe, so political, economic, and certainly sovereign, certainly on the fixed income side, to actually stabilise before we see that long kind of grind lower in the euro, or that more prolonged grind lower in the euro, where we see euro dollar really start to lose track. Lose some traction. Until then, we think, until that decision is made, we think we're going to be hovering around this 130 mark. And that's largely because of that relative difference in stance between the ECB and the Fed. The Fed embraces QE warm-heartedly. The ECB does not, kind of avoids it like that, terrible relative you don't want to meet at a Christmas party or something. And so because of that, that's why we think it's kind of oscillating around this 130 mark. But obviously, yesterday's news of those unsterilized euros sloshing around the European system, doesn't really give us, doesn't actually, obviously it's very, very small. It's certainly not QE. It hasn't been announced as QE. But if we were to see a bit more of this, then it could be perceived as QE. So we're uncertain at the moment. Hence why we're having a lot of choppiness. And we would expect the same type of thing to happen. You could say if we look at the 60-minute chart, we've really had a slow meander down to where we are now, which is at, just below 133 essentially. But right now it does look like we've based there at 132.36, and as I said, look out for that 133.20 level. That's a key resistance level in the short term. So let's take a quick look at euro sterling. Euro sterling has been kind of an interesting one. It's really just traded sideways. We would point out, so this is the 60-minute chart. If I just go on a longer term chart, just to show you the importance of where we are right now. This goes back to kind of a year nearly. So just no, it is. This is a year chart. So as you can see, if you're looking at where we are, we're weak within the range, most definitely. The one thing I'd point out, this 85 level here, absolutely crucial level of support. We're currently below 85.50, which had been the previous level of support, as you can see here. We're below there. We're below there right now. We're at 85.30, and so the next level to watch is that 85 figure. Now, someone's just asked, when you say a level is respected, what does that actually mean? Now, the one thing I would say is that, in the FX markets, we tend to get these big psychological levels. In euro, dollar is 130. As you can see in euro sterling here, it's 85. So it doesn't, in practical terms, it just essentially means a level of support that hasn't been breached in a long time, or if it has been breached, it tends to bounce back from that level. So that's why I mean that it seems to be a respected level, because obviously below there signals a much larger shift or a massive change in direction, something like that. So even though that you can look at what's going on in euro sterling right now, you can say, yep, absolutely very weak in its range. Looks like a bit of a nice downtrend going on. Essentially, 85 could be the level where things might change a little bit, whereby either it carries on that downtrend and breaks below 85, or it doesn't, or it bounces back and then hello, that's the end of that downtrend, and euro sterling is back to kind of heading towards 86, 87, maybe back up to kind of the 88 highs from mid-October. And that's what I mean by that. They're kind of levels where they're game changer levels, and whenever we kind of get into changes of trend, especially for these major currency pairs, there's usually a bit of hesitation, a bit of dipping your toe in, a bit of dipping your toe out, a bit of, I suppose, people stop to think at those levels, way more than they do at other levels. For example, 135 in euro dollar, or let's even look here, 86.50, well, it was easily broken. You could argue there. But I would just say this 85 level, as you can see, for the bulk of this year, certainly since March, we've never been below there. So that's what I mean by that. I'm also going to show you Aussie, because that's again another, that's been the worst performer today so far. That's the daily chart. So as you can see, so choppy at the moment, just going up and down, but very much range bound. Going back to the shorter term chart. Bit of a hard day, but as I said, when we see this kind of shift going on, in risk, so it seems like, the markets had sharp falls overnight during the Asia session. As I said, the reason for that was those S&P bank downgrades. You've also got those, the EFSF and the Eurozone finance ministers meetings. There's a lot of headline risk really weighing on the Aussie in particular, really scuppering its good week. It had a very good start to the week. It was as high as kind of 100.70. So I would just point out a few levels to watch. 100.70 very much the key here now. That's key resistance at the moment. We haven't been able to break through that the past 2 days. So as you can see, nice double top there. We've since gone kind of back up there. So you could argue maybe a mini head and shoulders, but I would say it's pretty weak actually. Potentially, what this shows to me is that the 99.50 is actually that certainly in the very, very short term, we're really range trading, and we're trading based on on momentum as well. So what you're seeing here, 99.50 or say 99.35 on the downside with 100.70 on the upside. That seems to be where we're oscillating right now. Again, very, very choppy. We've been much lower than that. I mean, it doesn't seem that long ago that we were, in fact, it was only Friday that we were kind of down below 97. So we've had a very strong start to the week. But it does look like we're capped a little bit at 100.70. But we have bounced off some good resistance because, again, that was the key support here. That 99.50, so resistance at 100.70, good support here at 99.50. Are we making a bit of a short-term pattern? Well, I'm going to take a look at the long-term charts to see what that means. No, not in my mind. We're not at all. We are range trading. Now, one thing you could say here, could this be a little bit of a bull flag on the hourlies? Potentially. But I still think that 100.70 level is being quite well respected. Looking at the more daily charts, I'm going to clear some of these lines because they're just annoying. Get you to see that a bit better. Again, it's very similar to euro dollar, which kind of worries me here a little bit about further Aussie strength because, again, just over the past year, over the past 12 months, this is a daily chart, so it does go back the past 12 months. We've just seen this kind of general weakening. So a series of kind of lower highs. So after hitting that 110, we then hit kind of just below 107, then kind of didn't hold too well at 105. And here we are again. So if that high is 100.70 or 100.70, then that's kind of certainly something to worry about. I'd also just like to do a chart on gold. Just bear with me. I'm just going to change my chart. So now I'll be able to see a Bloomberg chart, which is a gold chart. What does this show us? Well, this is the daily chart, candlestick chart. Those of you who joined last week will have noticed that I had looked at or pointed out the fact that the 50-day moving average, that's the pink line on this chart, had crossed below the 100-day moving average. Now, traditionally, that is a very bearish sign. Now, what we did see really was euro dollar, with gold, priced in dollars, obviously, really start to kind of dip below, or really start to kind of test the waters below 1700. Since then, it's been really stuck in a range between kind of 1730 on the upside and 1660 on the downside. Again, we tend to think that that basically this crossover right now still points to, some slightly weakening momentum. Obviously, you've got this kind of resistance level here, which is 1721, which is the 100-day moving average. We're currently about 1710. So we think we're kind of in choppy range trading conditions. That's certainly what the technical signals are telling us. Now, I'm also just going to take a quick look at the Ichimoku. Just bear with me one moment. Get it for you. As you can see here, you should be able to see the Ichimoku. I'll just show it to you again. Sorry, bear with me. Great. You should be able to now see the Ichimoku cloud. I would also note that there's another key resistance level here, which is 1726. So that 1720 level, 1725, 26 level, also incredibly important resistance. That's the top of the Ichimoku cloud. We really need to get above here, but as I said, as you can see very much on the Ichimoku cloud as well, if you can just look, you've got the pink line down here, that's our Tenkan line. It's a very key moving average for the Ichimoku indicators. That seems to be acting as good support, which is 1702, and then on the upside, obviously 1720. So could be a very, very tight range. But as I said, technical indicators certainly don't point to a strong move higher. Now, I'd also like to show you just something on stocks. Just bear with me while I pull up my chart here. So this is the FTSE. Now it's been expanded to just show you really the key level that we're at. So the FTSE, as you can see here, the top of the cloud is at 5342. We've rejected that very, very keenly. So we're in the cloud now. So it seems like we're range trading. However, support does lie at 5222. We're currently at 5285. So we really are in the middle of a trend, which is just kind of trading sideways for a little bit. But we're certainly not, this is what I was talking, a lot of uncertainty in the market, a lot of kind of sitting on the sidelines. And this is exactly what I mean, really. The other thing that I would add today is obviously month end. That is key. We're going to have a little bit of rebalancing. It should be fairly negative, fairly neutral for the euro. It could be slightly worse for the pound, purely because over the past month we've seen a lot of inflow into, a large amount of inflows into UK gilts. So as portfolio managers rebalance their portfolios, and then we could actually start seeing, we could actually see some downward impact on the pound. That's just worth watching. But generally for the FTSE, it's had a very bad month. It's interesting because when you get into December, you often see a lot of portfolio managers, especially after the year that we've had, they might be sitting on the sidelines. We might see a little bit of kind of, very, very volatile, thin volume trading, which can, for the next month up until the Christmas, break. So it could be, particularly, volatile, certainly, with some large outsized moves. So that's kind of, certainly worth watching out for and something to point out in this last day of November. Now, I'm happy to take some questions. If you've got any, please let me know. We've got another couple of minutes. Again, as I said, so someone would like to know whether or not the UK Chancellor's statement had any impact on the market. Now, bear with me, because I'm just going to actually, that reminds me of something I wanted to show you guys. Basically, these big statements, we were prepped. We knew exactly what they were beforehand. We knew what to expect, that growth was going to be revised down. We knew that, our borrowing costs were going to be very difficult to reach, or our borrowing targets, were going to be very difficult to reach. Again, that's exactly what he said. The other thing that he mentioned, which I thought was very interesting and very clever of him to do, was to really change the debate and start talking about how good it is for households and the country to have low interest rates. Now, bear with me, I'm going to show you this and show you what impact essentially the Chancellor's speech has had, or generally the Chancellor's speech has had. Great. So the chart in front of you, it looks like a big squiggly mess. Well, it's not. But what it is essentially is the white line are UK 10-year gilt yields, and the orange line are German 10-year gilt yields. So as you can see here, maybe if I just go back a little bit, very much trading together, trading in line. The overall level, or the absolute level, has usually been, the UK has usually had higher rates, just about higher rates than German debt of similar maturity. That is not the case, as you can see. The last few days, obviously, we've had issues in Germany as well, that failed debt auction and that kind of shift between people thinking that Germany is going to have kind of an outside. Germany's finances are basically going to be hit because saving the Eurozone is a zero-sum game. Some people win, that would be the weaker sovereigns. Some people lose, that would be the stronger sovereigns, because they have to bail the weaker ones out. But what I would say here is that what does this mean in terms of trading? Well, you can look at the fact that so when gilt yields fall, that means prices are higher, so that means there's more demand into gilts. So right now there's more demand for gilts than there are for German bunds. What that means is there's obviously going to be a little bit more, or there should be a little bit more flow into the pound than there is into the euro. So we should start to see, or the euro, funnily enough, the pound can sometimes catch it. It hasn't collapsed in any way. It's looking fairly strong, certainly against the euro. It's looking okay against the dollar as well. It's obviously, it's weakening with overall risk appetite. But basically, when the risk appetite falls through the floor, this kind of bid, the safe haven bid, could basically protect it or keep a floor in, so that sterling doesn't fall too far. So the lows have really been. In fact, I'll just show you that if you just bear with me. This is just a cable chart. The low has really been that kind of 154, just above 154 mark. And that, we think that floor has very much been respected over the past year. Obviously, it has gone below that to kind of 153.50. But what I mean here is that, why I'm talking about this is that basically this could be the floor because of the interest in gilt, so UK gilt yield. So even though the UK economy isn't doing well, it has a plan to sort its debt crisis out. Now, there are problems with that plan, but it has a plan, and the market's like that. So it's continuing to attract interest into gilts, which is also keeping a floor, we believe, kind of almost like a mini safe haven bid in the pound. It certainly is a safe haven out of all the European currencies anyway. Okay, so someone's just asked me to look at Kiwi dollar, which I'm very happy to do. I like the old Kiwi sometimes. Bear with me one moment. So this is it on a daily chart. So as you can see, very much moving with the Aussie dollar. So if I just show it to you on a daily basis, that's the Kiwi, and then just bear with me a moment. That's the Aussie. So the Kiwi is slightly less, the Kiwi is certainly slightly less volatile. That's for sure, but it does tend to move in that overall direction, as one would expect, because it is a commodity currency, essentially. So as you can see, let's go shorter term here. This is the hourly chart, looking a bit weak. 50-day moving average at 75.80. Testing that, testing support there at 75.80 again, that 50-day moving average. We're going to look at a much shorter time frame just to see what's going on. And yes, we're seeing exactly the same as we are seeing in the euro and the Aussie. So as I was, the one thing I would say about Kiwi, nice to see, what I would say about the Kiwi dollar is that it tends to move with overall kind of direction. There's a little bit of thinner volumes into it. And it's not moving on the back of its own kind of domestic fundamentals. It's moving very much in terms of global risk appetite. So as we saw with the euro, as we saw with the Aussie, I'd like to point out to you the RSI and the MACD are both looking a little bit oversold there on a very short-term level, and we are bouncing off this 75.80 resistance, which, as I pointed out, is this key level here. So it's a key support level here, really, which is a 50-day moving average. Anyway, so I'm very pleased that I can deliver some of you some FX notes in an English accent. I know there's a lot of you, there's a lot of men out there, so it can always be good to mix things up a little bit. But anyway, good luck trading today. I hope that was all useful. As I said, we're certainly in a very uncertain environment. Also, watch out for the fact that it is month end, so you can see some crazy things go on in month end. And obviously then we move into December, which is another crazy month. But anyway, I'm going to leave you all now. Good luck trading, and hopefully some of you can join me on Friday. That would be great. Okay, bye-bye.